Hi everybody, this is Trader72. Welcome back to my YouTube channel. I hope you're well on this fine afternoon in London. It's sunny here and blue skies. So, without further ado, let's get on with why I bought into S&P Global. I wanted to share with you guys a little bit about the company, the description of the company, where they're at, why they're down. A little breakdown in terms of their balance sheet and their fundamentals, and also working out the actual intrinsic price of the actual stock, as I've kept going on about it for quite a few videos now in terms of value investing, and also what the margin of safety is at, and that will give you an overall picture of why I bought into S&P Global. Please do your own due diligence, your own search. I'm only here as advisory, and obviously that makes more sense for you guys to work out if this is the business for you. Now, let's start straight to the point. What is the description of S&P Global? Well, S&P Global is basically a global ratings company, as well as energy, mobility, and it runs the S&P Dow Jones indices. So that's four major businesses under one roof, specifically the credit ratings and the S&P Global, which is irreplaceable and is basically a complete monopoly of that market. Only themselves and Moody's own that credit ratings market, hence the huge moat. I will come to the moat in a minute in terms of the 4Ms, which obviously is part of the criteria of my search. So it obviously runs all these different ratings. It works in conjunction with governments, corporate bond companies, corporate companies obviously, and it issues bonds based on credit ratings. It also does lots of professional research for your company, market data, derived analytics, valuation services, it says there, enterprise solutions such as software, workflow solutions, and credit and risk solution for selling credit ratings and related to data research. So I think you guys get the gist there, that is what the company does as a overall. I think the two big takeaways, obviously the credit ratings in the S&P 500, what it runs as a licenses. The business is run pretty much on subscription, which means it has constant revenue. The margins are amazing, which I will share with you in a minute. So without further ado, let's have a quick look at the overview of the company. As you can see there from the 1 year chart, and we're just going to go on the 1 year chart for now, the stock has taken a huge dip from its highs of around 540, which is pretty much the 52-week high, although you could argue that 550 is pretty much the 52-week high. Back in September last year, it took another dip, but it has taken a huge dip, and I'm going to go through why this dip happened there, and why when I bought back in. Obviously on the dip, some people may say. I don't like to look at it as a dip. I bought it because of its price and how it relates to the intrinsic price and the margin of safety, which again is something I will go to in a minute, in a short while. So that is where we are at the moment. Now, going to the financials, let's go and have a quick look at the financials and the highlights, the income, the balance sheet, and go to the highlights, which gives you an overall picture. I'm not going to bore you with all the details of everything that goes on within that, all the numbers, but let's have a quick look at the chart. Just to give you a very simple chart here. Revenue up every year. Now we want to see this, guys, an absolute staircase of revenue right up to the top. Now it has slowed down the last few years, but like every good company, it can't always sustain a constant huge growth. So that's a wonderful start to the balance sheet. Again, I said on year, it has been going up, as you can see there, every year in growth, although it has come back down a little bit more since 24. Gross margin, again, staircase from 2018 to 2026. This is based on pretty much on the last 5 years. Net income, again, it has it up and down, obviously due to COVID back in 2021, but certainly recovered since then. So again, that's pretty good. The price to earnings, now that obviously is at the moment it was at 50 times earnings at one stage back in 23-24, and as you can see, it's got slightly cheaper over the years, down to 27 and 29 respectively, so much cheaper than it used to be, and that's obviously down to the downturn of the share price as well. Now, in terms of that's, obviously you can go through lots of different income statement, balance, cash flow, which I can go to in a minute. In terms of the free cash flow is amazing with this company. But obviously the other key points are the ROIC, which obviously the return on investment, which obviously is something that we need to look at as well. And as I said, as long as it's above the 10% threshold, that's what we're looking for. So that is the actual balance sheet. Total debt is pretty low. It's 13 billion at the moment. Let's have a quick look at the snapshot again of the company. So as you can see, beta wise, it's not a volatile stock. It's only just above 1.20. 1.1, it's at 122, which gives you an idea of the steadiness of the stock compared to the market volatility. Anything under 1 is obviously very much defense and steady. It's slightly above that, but pretty good. Shares outstanding is obviously quite a bit there at 298 million. That's what whoever owns the shares at the moment in the actual active market. Short interest is very slow at 1.50, so nobody's shorting the stock too much at the moment. Market cap 128 billion versus enterprise value of 145. Now, the reason why I'm looking at that is that it gives you the difference of what the debt is of the company. And the current debt at the moment is at $13.71 billion. It's a financial company, so it does borrow money on and off. It's quite liquid, illiquid even, should I say. So it does move around a bit like any banks or any credit cards. That is the way it works. It's not like a Microsoft, which has zero leverage, or a Sprouts Farmers in retail where they have a very minimal leverage. But there is a good point to this situation in terms that they can pay back that debt very quickly based on their free cash flow, which I will go to in a minute. So all in all, really, the price to book is at four times enterprise. So that's quite interesting. Cash, obviously, versus investment at 1.8 billion. Very high margins, obviously. If we go quickly to the gross margin, just to give you an idea, again, just to, margin of percentage is at 70%. Currently, 70%. So that's for every dollar they make 70% of gross margin, 70p on the dollar. That is an outstanding return, really. And the net income is just under 30%. That's after everything's been stripped out. So return on equity is above the 10% threshold of 13%. That's the return, the money that the company makes and what they're going to reinvest it in. Again, just to explain to you guys, in case some of you may not know this, I'm sure most of you do, but always good to recap on that. Obviously, there's some strong capex, obviously capex meaning what they're spending. They do tend to buy companies or other analytic companies. Recently, they've bought a couple of companies, so it obviously is expanding constantly. So let's get to the nitty gritty of now we've seen the basic numbers. I could go through some more if you guys want to obviously ask me in terms of on the comments. But let's look at why the stock is currently under pressure very quickly. High interest rates, never good for a company like S&P Global. They obviously do credit ratings and borrow money. Basically higher rates means less borrowing, fewer bonds issued, and obviously it hits the bottom line. Obviously, a high interest stock at the high interest, we're still at a high-ish interest at the moment due to the inflation being quite sticky. So obviously less IPOs, less M&A, which obviously is takeovers, debt maker quieter. So that means transaction-driven revenue has softened slightly. SPGI trades at a premium, blah, blah, blah. AI disruption. Now, this is possibly one of the key points and why I've highlighted it in red. Is AI disruption on software. As you well know, like Intuit and Salesforce have been hammered recently, Adobe as well, which I own. And that is because suddenly there was a fear that some of the services that S&P Global are offering will be replaced by AI. Now, where the hell they got to that point, I don't know why. They've invested in AI themselves and they are working with the software AI. Now, one of the reasons why we think this is obviously overdone and exaggerated is the enterprise adoption of AI is slow. Financial data, highly regulated and sensitive, so it does need human interaction. What they do, obviously, companies won't rip out core system overnight, which means obviously that would have to happen in terms of AI. SPGI is a strong moat than people think. Rating indices, pricing data cannot be replaced by AI, replicated by AI in terms of running an indice, pricing data that still has to be overseen by a human touch. Credit ratings are deeply embedded within the global finance. That means they would have to be stripped out in terms of credit rating and where they are. SPGI is integrating AI into its own platform, which actually is enhancing the product they're working with. And I think that is a key point there, why it won't be replaced by AI and it won't go down potentially the way of some of the AI software companies that may well disappear in the next few years due to the AI expansion. So the fact that they've actually embraced it makes a major difference, and it's actually enhancing their product. So that's something to look out for there. So that's a key point. Essential to the meaning, the 4Ms, which I buy to at all time. Phil Town's book I read from. That's how I got into value investing. Very much my own system I use. So I haven't completely copycatted him, but obviously it's important that you implement some of from various different value investors, and obviously the 4Ms, as you've heard me before, is the key point. Meaning, understanding the company, tick. Moat, tick. Oligopoly, which obviously owns with Moody's. They are one of 2 companies in that very market, unlike other big companies that might have 4 or 5 competitors, maybe Uber, Microsoft in certain point. Competition there from Google and so forth. This is a oligopoly, which means a complete monopoly of 2. Management consistent with allocation. Margin safety I'll come to in a minute. So data monopoly, the moat, the credit rating, government, company bonds, irreplaceable, indexes, S&P, irreplaceable, financial data terminals, irreplaceable. So you can't replace this easily. It can be replaced eventually, but I think it will take time just due to the infrastructure that S&P Global is at, and that's why I love S&P Global at this moment. That's why I've invested my money into them. So obviously it has high margins, recurring revenue, pricing power. It has that all of the above. Obviously that's why the company is making such good money in terms of margins. So structure, strong and predictable growth, expected between 6 to 8% revenue growth in 2026. I think it can be more than that. I think it can go up to 10%. It has high margin subscription model, which obviously is key. I think Adobe is another one that has the same model. Subscription means that you don't have dips. You don't have dips in terms of revenue. People will pay for the service on a month-to-month basis, and the actual margins are, as you can see from gross margin, is phenomenal. It also is expanding its EPS over the next 3 years. So again, the EPS will be 7 to 10% up every year. The revenue growth, I think, personally could be a bit more than that. I think you'd be looking at 10 to 12%. Again, that is up to you to work out whether you want to be conservative or moving forward. That will obviously dictate how my DCF model will work for the intrinsic price. S&P wins when more bonds are issued, more tradings happen, more data is needed. That obviously goes without saying. Global earnings expected to grow by 15% in 2026. That is obviously quite a jump. I think 15% is pretty reasonable. Again, I would say probably between 12 and 15. But there's going to be more demands for S&P services. So that is where the plus are for the company. Recurring revenue machine is fantastic. Now, just to bear in mind, just to kind of grab back why the company's gone down, I think there's obviously a very soft trading update, which is cyclical back in February, which didn't help in terms of the forecast for the 26. I think that the growth is slightly less than what people expected. The market does expect a lot. And on top of that, the AI tailwind of software replacing some of the companies it got caught into. So that's the double whammy why the stock price fell back to almost 380 from a comfortable 500. So quite a fall. So why stock? I'm just going to recap. AI fear, slow short-term growth, cyclical slowdown. That is why the stock is down. So that gives you an idea. Again, please do your due diligence. Any further questions, please make comments below. And final investor, meaning Moat management. We've got already that. We've already discussed it. Now, the debt versus equity is also very important. It's under 2, which means that the company can pay its debt within 2 to 3 years. That's very important indeed, as it says, as it highlights there, using the free cash flow, which is the lifeblood of the company. Whatever cash they make, they reinvest, or they put it towards debt, or controlling the debt. And at this rate, at the moment, if they had to, based on a free cash flow of a yearly, on a 12-month basis, at $5.4 billion. So that means they could pay back their debt of 11 to 30 million within 2 to 3 years. That is amazing. That's what you want if you're going to invest in the company. Make sure that the company can afford to pay its debt. If it doesn't, it's not worth investing in. That is lesson number 1 or 2 or 3 of buying into a stock. So that's where we are now. Intrinsic price, to finish this off, because I don't want to go on too much about it. In terms of intrinsic price, I have worked out the intrinsic price based on this discounted cash flow, as I mentioned. I'm looking at 10 to 12% growth. I would say 12%. The 5 years and the 10 years show you that it's between 16 and 11%. So I think 12% is very reasonable. The reverse DCF, which is what these markets are actually evaluating the revenue, the discount is at 5.40 currently. So that has quite a way to go there in terms of 5.40 to 12%, which gives you an idea that it is undervalued. I can go through the DCF model, reverse DCF model at some stage with you guys in the next few weeks. So 12% means 623. 623 means, what does it mean? Well, 623 based on the margin of safety gives me a margin of safety of 31%, which is in my ballpark of 25 to 30% minimum to actually buy into a stock. Do remember that when you buy a stock and it's overvalued, most people lose their money that way because the stock is overvalued and they get hurt when the stock crashes. As opposed for you guys to buy the price at a true value of the stock based on the DCF models. There's several ways of working in DCF, an intrinsic price, but the DCF model is the one I buy to. And if it does fall, at least you will fall less harder than if you buy it at an overvalued price. It is about what the company story is about and the actual share price. That's how you marry the two together to get an overall picture of the stock. So at this moment, the margin of safety of 31 is pretty damn good, and that's why I bought it at, well, a tranche at 435 and 421. So to have a quick last look at the actual price, S&P Global currently at 428. As you can see, the fallout from the AI software and the results have obviously given it, and it's sitting currently just on the 200-day moving average, looking like it's still very much in selling mode on the MACD, and the actual momentum is still under 50, as you can see the little dotted line there, which means that the momentum is not quite right yet, but I'm hoping that it will pick up. So as you will see at the moment, I have got I'm £5 in the red at the moment on S&P Global, but I do bought obviously 2 tranches, one at 421 and one at 435, which gives me an overall price of 428. I would probably buy more if I could. I think if it goes below 420, maybe even 410 to 405, I will buy more. If not, well, I'm hoping it will go up to the north of $500, not pound, sorry. So that is my current data analysis on the actual S&P Global. I hope you enjoyed. This is really a dive into why I bought into the stock, really. It's whatever long-term investor you are, just keeping an eye on the market is very important. As always, do your own research. Keep your risk in check. That's the main thing. Make sure that your margins don't get overbought. And let's hope that you guys look at it and see what you think. It's up to you, of course. You do your own due diligence. Any other companies that you would like me to have a look at in terms of analysis or a little deep dive, please let me know in the comments below. This is Trader 72. It's over now. Speak to you soon.